Tiger Stocks Live. If you can hear me loud and clearly, please say good day in the chat. Jayesh, it's so good to see you in the chat, mate. Welcome. Um, and welcome to everyone. Got coin. We're starting a couple of minutes behind schedule because I was just doing some last minute checks on some of the companies that we'll be covering today, which include mostly the trade desk. I followed the trade desk on and off for many years. Um, Impressive business, but it's a rapidly changing industry, as we'll discuss in just a moment. For those of you that don't know, this is the fourth installment, the final installment of the Tiger Stocks Live series brought to you by Tiger Brokers. Done some really interesting changes to the platform over the last few weeks and months. If you haven't already checked it out, there is a link in the YouTube video. Just below the YouTube video, there's a link there where you can create an account. And as you do, you'll get some goodies, some things thrown in just for signing up. But also, if you fund your account and meet a few criteria, of course, around that, you can go in the draw to win some cash that is added to your Tiger account. Over the four-part series, it was $2,000 up for grabs, and we've already had quite a few winners with that. There are T's and C's and those types of things available in that link below the video. If you click that, it's right at the very top there. So today we're going to be covering 4 brand new stocks to the series. We've covered quite a few already, which we'll recap in just a moment. We'll be covering the trade desk. We've got a bit of Amazon in here, NVIDIA, and of course Alphabet/Google. A few years ago, many of you may remember that Alphabet became the new name for the corporate entity that is Google. And I think one of the reasons at the time that they renamed from Google to Alphabet is simply because of a lot of the kind of legislative risk and political risk they might have faced from becoming too dominant. It actually might sound trivial to most of us, but just by changing their name on the stock exchange, it actually helps them, escape some of the kind of, I guess, concerns that might come from legislators and things like this in the United States. And you might remember that Facebook renamed recently away from Facebook to Meta platforms. And that's obviously because its business expanded. And you could say the same about Google. But because of Google's dominance over the years, there's been a lot of talk about breaking it up, similar to Microsoft in the early days, like the late 90s and early 2000s. Of course, we'll be talking about Amazon and all of its wonderful businesses as well. But before we get into the companies, the stocks, it is vitally important that you remember the general advice warning. Even though I may be answering questions in the chat today, and I do encourage you to chuck them in there, just remember that I don't know your personal circumstances, your needs, goals, or objectives. So because of that, you shouldn't rely on the information, act on it, trade on it, that type of thing. You should always consult a licensed and trusted financial advisor before you make a decision to act. That also applies to things like ETFs or exchange traded funds and those types of things, even brokerage accounts, which we've just spoken about, Tiger Brokers. It's important that you read the fees, the T's and C's, and any product disclosure statements. That's a fancy word for something that tells you about a financial product in Australia. So many of you will be familiar. We'll just jump into the Tiger Brokers platform. This is the desktop platform. You can see here it opens up on a screen. This is for the trade desk, or TTD is the ticker symbol. Down the right-hand side here, you can see all of the different kind of this quick analysis that you get. So this is a fundamental or financials tab down here. You can see things like where its income comes from. You can see a growth rate. You can see the profitability. You can see net income, total revenue, all of those things you probably want to see at a really quick glance. Up the top here, there's this material tab. Now you can't see this because what actually happens when I click it is it pops up in a new tab, and my recording software doesn't show you it immediately. So I'm not going to click it now, but rest assured, if you do click that in your Tiger Brokers portal, it actually pops up with basically all of the financial information. And I will show you what that looks like in a little while. I just don't want to get off this screen just yet. But it shows you things like insider share ownership. So in the case of Trade Desk, we know the founder, Jeff Green, he's one of the big holders. It shows you dividends. It shows you the different financial segments, which is one of my favorite things, the financials, all that sort of stuff, business descriptions, all that sort of stuff, if you click the materials tab. And obviously here we can just quickly traverse to other businesses as well, and it updates everything that you can see in front of you here. So this is the desktop app which you can download. I've got this on the Mac at the moment, just here at home. The app is also similar. The app is probably actually easier to use and get around. Has features like auto invest and that type of thing as well. Okay, so I've also got many other tabs open here, which I'm going to share with you now. And apologies for the switching back and forth and all these types of things. So don't forget, you can claim your reward. I'll bring that up on the screen just here. If you do go to the link in your video feed there. So this is the fourth of four. If you want to go back in the catalog, do it, because these were heaps of fun. You may remember that we did score, and I'll just zoom in a bit here. We did score the other companies. We scored some Australian companies, some US companies, some Aussie companies, and now back to the US. And we scored them out of 50 to give you a sense of which companies are probably the highest quality. And we scored them for these metrics, which I explained in week 1. So let's just quickly recap them. Companies with growing sales and a big opportunity, defensive business models, a business obviously that you can understand, that has good and aligned management, strong profitability and cash flow, and a reasonable price. Now, you might be seeing down the scoring here. This is a scoring range. I don't ascribe a big score to trying to buy cheap stocks. Many of you know this already, but just for those of you that may be tuning in for the first time from Instagram or whatever, when I've done these lives in the past, done over 300 of these, I believe now, in terms of the live shows. And always, 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 I'm quick to emphasize that there are no secrets to stock market investing. As much as we think there are, or people would tell you that there are not, especially when it comes to valuation. Of course, valuation matters, as like the greats like Warren Buffett and all those will tell you. But at the end of the day, it's not a science. There's no one formula that predicts everything. And you can take that from me, because I teach the Value Investor program here in Australia, and have taught thousands of people valuation, including people that hold chartered financial analyst designations, that go on and teach at universities, industry professionals. And I can tell you that no one has a secret sauce. So what we do here is we don't ascribe as big of a range for that, because if you're a long-term investor, which I'm about to get to why this matters, the other things matter more. So the things about the actual company matter more than the price that you pay if, and this is the key criteria, if you are a long-term investor like me. If you're just trying to trade stocks, this is probably not the show for you. If you're trying to create long-term wealth from the stock market by identifying great businesses, this probably is the show for you. There are many different ways to put your money into the stock market, and I believe that long-term investing is the only one that makes sense. And so we'll dive into that now. So you can see here, we've covered the different stocks over time. If you want to go back, I highly recommend this one, the most recent before this. This was heaps of fun. It covers a lot of the Aussie companies, in particular, 2 or 3 really interesting Aussie companies. So the theme for today is US digital companies, and obviously Amazon, NVIDIA, these types of things. Now, Gavir on X challenged me, because he saw the 4 companies that we were talking about. He challenged me not to use, and I'm just going to say them for the purposes of understanding the challenge, Gavir. He challenged me not to use the words AI or artificial intelligence throughout the show. So instead of that, I've said to him, I will try and say something along the lines of nearly human intelligence every time I go to say AI. So nearly human intelligence, because obviously all of these companies have some sort of tech focus, and the buzzwords at the moment are those words that Gavir is trying to steer me away from. So I'm going to try and say nearly human intelligence. And just a reminder before we get into the stocks, one final one, is that I don't invest all of my money into individual stocks. I used to. Now I build portfolios for our members at Rask and for our investors it's primarily the core portfolio here, and that's made up mostly of ETFs, or exchange traded funds, index funds, and the things that help you sleep at night. But of course, I love stocks and I love businesses, so I do own stocks, and I do plan on buying a lot more over the next few years. And they're what we call satellites. They go around the outside. So a low-cost core, simple, helps you sleep at night. You don't have to do the stuff around the outside, but a lot of our members do it, and I love it, and so on. And that's what we're talking about today: satellite positions, individual stocks. Okay, so the four we're covering today: Alphabet, Trade Desk, NVIDIA, Amazon, or in ticker symbols GOOGL. We've got TTD, and we've got NVDA and AMZN. Those are the ticker symbols. And I'm going to get into all four of these in just a moment, but I wanted to explain what I just told you about long-term investing in stocks. And feel free to dump your questions in the chat, guys. Kavir, good to see you in the chat, mate. Okay, so studying successful investors right around the world, I've realized a few things when it comes to buying and investing in growth stocks, and in particular, the types of companies that will change your life. So many of you will know I've owned a few companies, and I've recommended a few companies that have gone up multiples in excess of what I paid for them. I don't claim to be the best at this. You can go on Twitter, and I'll bring this up here, and you can follow gentlemen like, say, David Gardner, who I think is probably the best investor in the world at growth investing. I don't think there's anyone, I haven't found anyone that's better than David in the world, at least over the past 30 years since the internet age. He's one of the co-founders of the Motley Fool, recently stepped back, but he still runs the Rule Breaker Investing podcast, if you're familiar. And all of the companies that we talk about today, I'm just going back over my mind, all of them he has recommended, I believe, in the past to his community. And he's, I believe, I could be wrong, held for a very long time. One of the things that, this is not necessarily a lesson from him, but something that I've learned in studying him over many years, is that a lot of people, when they think about investing in growth stocks, they tend to get sucked into buying companies which are, as Gavir was saying before, like a buzzword. So you might say, I won't say it because I'm not allowed to say it, but you might talk about things like this: nearly human intelligence. A few years ago, it was cannabis. A few years before that, it was, dot-com stocks, machine learning, all of these businesses that are just like all of these themes that are just absolute fluff, right? And so these are what you tend to see, these fluffy things. I think Claude Walker from A Rich Life calls them, you can't pat all the fluffy dogs or something like this. But these are the types of businesses that tend to go up, or stocks, I should say, not really businesses, stocks that tend to go up within 1 to 2 years, right? And so in the short term, they kind of look interesting because they make big announcements and they kind of sound like they're riding this wave of growth that's approaching quickly. But the really good businesses aren't riding these frothy waves that last a year or two or months, right? Like a good one in Australia is BrainChip. For those of you that don't know, BrainChip trades under the ticker symbol BRN on the ASX, and it claims to provide artificial intelligence services and be a world leader. And that's clearly, as at the time of recording today, is proven not to be the case. Could change, but right now it seems that way. Now, what a lot of people do, if you focus on the little surfer that's down the bottom here, that's basically like trying to predict what the first wave of something is going to be. So you might be trying to, you're not recognizing that the thing that you're trying to invest in is going to be good, but it's not going to be around for a long time. What the really, really amazing businesses do, and we've covered this in a previous episode, particularly when we talked about Microsoft, if you go back to that episode, what the really, really good businesses do is they have a structural trend. That's what some people call it. I don't call it so much a structural trend. I think about it in terms of like waves, as if you're surfing. A wave like this is like the first wave. You think of an idea and it kind of is backing the company's future prospects. But then a bigger wave hits it and it rides even faster than ever before. A good example of this would have been Microsoft building the desktop computer software, Microsoft Windows, and then it was able to connect everyone to the internet and grow beyond that. And it moved even faster and faster and faster and faster. So it's like a wave on top of a wave. And if this surfer was a real person, they wouldn't know this thing's behind them, but all of a sudden they would just whoosh off into the future. Another secret to this long-term growth investing is finding companies that build the standards of an industry. So a lot of people are focused on trying to find businesses that have the next hot idea. They might sell like widgets, or they might have an old product that's with a new like it's taken a new kind of spin to it. And in effect, what they've done is they're just reinventing an old wheel, so to speak. Whereas the businesses that have this structural change tend to set the standards of that industry. Now, they don't just talk about setting the standards, they actually do it. So, a good example of this would be Facebook. Facebook basically reinvented how social media should be done, or it basically invented how it is done. And so nowadays, like when you see TikTok and these other types of social media platforms, they're just doing what Facebook has already done. They're just doing it with a new flavor. But the original standard setter was Facebook. You could say the same with Google and Google Search. Now, there were Alta Vista, Yahoo, Microsoft Bing, all of these different things over the years. But Google has set the standard for what it means to search the internet for search results. And NVIDIA is creating the GPUs that go in server farms and allow cloud computing to actually happen. So they're setting the standard for other players, many other players, in fact, in the industry. And what you want to find if you're a long-term growth investor is you want to find the businesses that set the standards. And the reason for this is because if these businesses set the standard, it means they have a foothold on the industry overall. Even though they might not control the entirety of that industry, they actually are setting the way business should be done. And in fact, they have control because consumers, politicians, everyone kind of holds them to account. A good example of this in the modern era is OpenAI. So many of you know ChatGPT. Nowadays, we just say, uh, people don't even know, most people don't even know, they just say ChatGPT. But what they're really talking about is a large language model, an LLM. Most people just say ChatGPT, even if they're talking about something else like Google Bard. They don't realize that there's a few different things because OpenAI has set the standard. It is their standard. Even though these other players exist, everyone just calls it ChatGPT. It's like, say, with Afterpay in the buy now, pay later scene, BNPL. They set the standard, then everyone else followed, and they accrued most of the benefits. It's like when you say the old cliche in investing is when something becomes a verb, a company name becomes a verb. So you might say just Afterpay it, just Google it, these types of things. These are the types of phrases that tell you a business is setting the standard. And this is important. Why? I've shared this a few weeks ago when we did, I think it was number 3 or number 2. And basically, what this chart shows you, and many of you who have tuned into the live shows before would know, in the first few years, so say here in year 1, and this is what I was referring to as the wave before, this chart from Boston Consulting Group basically shows you that if you're investing for just 1 year, the thing, statistically speaking, the thing that will produce your returns is actually just the change in a company's valuation. So let's say you buy Amazon stock. Let's say you buy Amazon and you pay, I don't know, I'm just going to use round figures. Let's just say it's $100 a share, right? Now, you might have paid a price to earnings ratio, a PE. Some of you will know what that means. It's just a valuation multiple of 10. Now, let's say the stock within 12 months goes to $150. So it's a 50% return. Normally, what has happened in this situation, normally, is the price earnings ratio has just gone to like 15, like 14 or 15 times. And what that basically tells you is that the share price only went up because the valuation expanded, not because the company did anything amazing, just that other investors are willing to pay you more for the same amount of profit. That's basically what happens from 1 year to the next. So when people are trying to trade stocks, or when people are saying, I'm a long-term investor and I'm going to buy Amazon today and hopefully sell it in December, what they're really gambling on is they're gambling on a change in valuation. Because anyone who's run a business will tell you that not a lot can be done in just 1 year, let alone when the company is worth 1.7 trillion US dollars. There's not a lot that changes in 1 year. But over 10 years, a lot changes. And that's where the sales and profitability of a company starts to take over. And it's also when things like profit margins start to really matter to your returns. And this would be like Amazon, instead of going to 150, it goes to 1500. So from $100 a share to $1500 a share, the price earnings ratio doesn't go to 150 times. It's because the profits increase. That's the predominant driver of the results. So basically, if you believe in this chart, which I do, basically what I'm telling you is if you invest for less than 5 years, you're basically betting on other people trying to pay you more for those shares in the future. If you're investing for more than 5 years, you're basically trying to predict what businesses will do well in the future. So you're actually an investor rather than a trader. And so if you want huge returns from individual stocks, my belief is that you almost certainly have to hold those shares for 5 years. Even people who say 3 years here, I would say it's not certain that what they're doing is long-term investing, because statistically speaking, it's really maybe just less than 50-50 chance, or just more than 50-50 chance they're actually picking a good business. More likely what they're doing is they're trying to predict what other investors are going to pay for that business in the future, which seems kind of risky to me. So the key takeaway, long-term investing requires you to find the businesses that will define the future rather than just figuring out what other people will pay. And the reason that all of this works is because a lot of investors, when they do their valuation work, they'll say have 5 years of forecasts in their financials, right? So in their spreadsheets, and they do their valuations, and all the big banks and that sort of stuff, when they do their thing, they'll take the first 5 years and they'll go like, profit in this year, this year, this year, this year, and this year. But what they don't do is once they get to year 5, typically a financial model just looks like this. They forecast the first 5 years, and after the 5th year, i.e. the 6th year and onwards, they just assume a constant growth rate for forever. And that's how they get their valuation. However, if you're focusing on the companies that grow and the companies that set the standards, what you'll typically find, and this is where a lot of these investors have got it wrong over the last 5 to 10 years or 20 years, is that these tech companies can keep growing faster than anyone ever imagined. And that period here also matches up to this period here. So most investors get this wrong, in my opinion. They think a company, oh yeah, it will grow for the next 5 years and then it will slow down, because that's what we're taught. When you throw an apple up in the air, gravity eventually kicks in and it falls. Then why, if you believe in that, then why was Amazon recently able to grow? Let me just zoom in a bit. Why was Amazon recently able to grow its sales 12% in one quarter, or that's for the full year? Why was it able to grow in double digits when it was already a $1.7 trillion business? This business has been around since the 90s. The reason is that people have underestimated this section of the graph. It's this section right here. It's the standards that AWS and all those have set. The final thing, and then we'll start talking about individual companies. There's no point trying to find these growth companies if you're not willing to endure the pain and you're not willing to endure the problem and the uncertainty of long-term investing. And the best way to think about this is you have to be one of the first people to the party. So you don't have to be there on day one. That's fine. It doesn't matter if you're not the first person to invest in a company. And you never will be unless you founded the company. You're not going to be the first person to invest in that company. But you have to be able to stay at the party longer than anyone else. That should be your challenge. So even when you've seen your stock price go up and then crash down, you need to be able to withstand that and keep focused on the business for the long term, because what you tend to find is that happens. I'll give you a tangible example of this. When I was invested in the trade desk for a long time. And when I invested sometime, I can't remember, it was probably around here, right? It's probably around here. Let's zoom in. And I was like, oh, yeah, this is a wonderful company. Sounds really great. Sounds like it's got a bright future. And then I held it. I was like, great. COVID hit and I freaked out. Now, on this chart in front of you, you can see here, it looks like a tiny little blip. But at the time, that went from $30 a share down to $16. So it almost halved. In fact, I'm pretty sure it got back near to the price I paid. So I was sitting on this like huge gain, and then it fell and I sold it right down here going, everything seems risky. COVID's here. I don't know what's going to happen to the trade desk with its digital advertising platform. I'm going to sell out now. And then look what happened. It went up 5 or 6 times within the matter of a year. And that's what I missed out on. So I wasn't willing to stay at the party for a very long time. Now, you might be saying, well, hey, Owen, couldn't it have gone the other way? Couldn't it have kept falling and gone to zero? And I would say, yes, it could have. And I would have lost $16 a share, which is the price at that time, just say. I would have lost $16 a share, which would have been pretty painful because I've lost my entire investment. What's that Warren Buffett rule? Don't lose money. Second rule, don't forget rule number 1. So I would have lost $16. But this is the secret sauce of this investing. If you stay at the party long enough and assuming that you've picked the right companies that set the standards, that have great management teams, that are redefining the future, that are leading the industry, so on and so forth. Sure, I would have lost $16, but if I held on, it would have gone up to $95. If you're a mathematically minded person, like most of us probably are, you would then realize that, hold on a second, you're saying, Owen, that I could lose 4 or 5 $16 companies. And if I just had one $95 company, it would equal itself out. And that's what I'm saying. So a lot of people, when they go into growth investing, they're not prepared for their stocks to fall, firstly, but they don't realize the bigger picture. You might lose on 2 or 3 of the companies, but the benefits of owning a company that then goes on to do this outweighs 5, 10, 20 other businesses. And I'm going to give you an example of this. David tweeted about it the other day. He's been quite active on Twitter recently. He's a wonderful investor, and I love to see when he does this stuff. He doesn't always talk up his biggest winners, but he should do it more, in my opinion. So he made a 100x return on NVIDIA. That's pretty well established. But there was one other one which he tweeted a little while ago. If I can find it, I will. Here we go. Is this the one? Oh, no, this is his Facebook investment. Here we go. So, yes, he reflected recently on his Amazon purchase. He bought Amazon and recommended it for the Motley Fool in 1997 at a price of 16 cents a share. So just in one day, the other day, whenever this was, the stock went up $12 a share, which for most of us, if you look at Amazon stock, if I can type in English, if you look at Amazon stock, you're like, oh yeah, $12 a share, that's less than 10% gain, right? Not a big deal. However, on his cost basis of 16 cents, that means his original investment, so say you put $1,000 in, went up 78 times in one day. You don't get this. You will never, ever, ever get this investing. That's my promise. I can't guarantee, but that's my promise. You will never, ever experience a return like this if you're holding shares for less than a couple of years. The only way you get this is if you own the shares for a very long time, go through the gut-wrenching times, because Amazon fell 95% after David recommended it. Went up and then fell 95%, and he kept on holding. Most people don't, by the way. You will never, ever get a return like that if you're not prepared to endure lots and lots of uncertainty. So that is the conversation for today. We're talking about companies that kind of fit all of these criteria at the front end, but a lot of people won't be able to huck it. They won't be able to stand going through this in order to get this. So now let's talk about them. So let's start with the business that is probably least well followed amongst you. And the reason for this is that you probably know a bit about the other businesses. So rather than repeat too much about them, I want to introduce you to a different business, which could be one of those businesses of the future. Gavir said, for the benefit of your viewers, I think we can limit the challenge. You can practice free speech once you read this. Thank you, Gavir. Okay, so I can say AI now. Thank you very much, rather than nearly human intelligence. So what does the trade desk do? The trade desk is a technology business. It's founded by a guy called Jeff Green. And I'm going to go back into just quickly to show you some of the financials. I'm going to jump back. Bring that up. And I'm going to bring this bit up. So I'm going to switch in the tabs. Let's go here. I'm going to switch to the trade desk tab, not AT&T. There we go, trade desk. Okay, so this is that extra material tab I was talking about before, where it's got all the information inside Target Brokers, where you can see the different information. So here we can see on the screen, the trade desk operates as a technology company in the United States and internationally. The company operates a self-service, cloud-based platform that allows buyers to plan, manage, optimize, and measure data-driven digital advertising campaigns across various ad formats and channels, including video, display, audio, out of home, native, and on social on various devices such as computers, mobiles, etc. The company was founded in 2009 or incorporated in 2009 and headquartered in California. Okay, so now I'm going to give you my definition of what it does, even though that's quite succinct. Trade Desk is a business that was built to help advertising agencies serve their ads on the internet. So if you think about it, if you see an ad when you visit the New York Times newspaper, or if you go onto Netflix and you see an advertisement, because they now offer advertising on Netflix, how is that ad put there? And is that advertising relevant to you? Now, this is a $1 trillion industry. So you might think, if you're not in advertising, as I'm not really, you might think, well, who cares? Well, everyone cares, because businesses, let's take a business like, say, my business, which is Rask. We help people invest, right? Now, if I wanted to find someone to get them to use our business, how would I do that? I could do a live stream like this and just hope randomly that people stumble across the video on YouTube, or I could run some advertising on YouTube itself and get people into the link and watching this video right now. We could also run some ads on, say, the Australian Financial Review website, or we could put an advertisement on the television, or on, say, I don't know, one of those smart TVs that you get where you watch, like, say, SBS or something like that, right? Many of you will be familiar that you can go on to, say, like SBS On Demand, or you can go onto Hulu or KO and you'll see ads. What Trade Desk does is it uses something called a demand side platform, and it allows the advertisers to say, Owen is running an ad. Now he's running a live show, this live show. Let's put that in front of people who like investing content that watch SBS. And then the ad intelligently is placed only when someone is watching SBS that has previously watched financial content. So in the background, it's calculating John Smith has watched a financial program in the last 24 hours. We will put the ad in front of him, but not Mrs. Smith, who has never watched a financial program in her life. So in effect, the trade desk is programmatically, like automatically, inserting a relevant ad in front of a relevant consumer. This is like gold to any advertiser, because there's no point spending $3 to put an ad in front of someone if there's no interest in the world. But if they are interested in financial content, you may as well put the ad there, because there's a chance they'll click on it. So this is what the Trade Desk does. It's one of the 3 biggest players in the world, and it puts ads across the internet, like is in standard website stuff, inside apps that connect to it, and also inside what they call connected TV, which is like Netflix and that sort of stuff. Now, they're not the only player. There are a few others, and one of the big ones is Google. So they're a demand side platform. It's really important to understand this lingo that I'm using, demand side platform. So the ad agencies use it, right? On the supply side, so there's demand and supply. On the supply side, you have the platforms. So they're the ones that they can supply the eyeballs to your ads. So that would be like the New York Times. It would be The Economist. It would be SBS. It would be Netflix. So they have separate software called supply side, and they effectively they push into the advertising marketplace what they have available, and then a platform like Trade Desk connects in and says, we can fill those slots with advertising. So that's how they kind of come together. And on that side of the platform, you've got things like Google and Amazon and all of those big platforms that enable advertising on their platforms. And on this side, you have the demand side, which is Trade Desk. So Trade Desk was started, we heard before, in around about the GFC, late 2000s. And it was started by this guy called Jeff Green here. On the screen from you can see it at the very top here, Jeff's name. Jeff was previously worked at Microsoft, and his business, I believe, just going off the top of my head, was bought by Microsoft. And here we go, we can see it. Yeah. So it was bought by Microsoft as an ad business. So it was an ad software business, and Microsoft bought it because they thought we could use that in our network. He worked there for a little while and then eventually went back out on his own, and Trade Desk is what you see before you today. To put in context how valuable this platform is and how sophisticated it is, I once heard that the Trade Desk platform does more computations than the New York Stock Exchange, the NASDAQ Stock Exchange, and I believe it was YouTube combined. So it does all of those calculations on which ads should be served where, sends the ads, who's that person that's watching that ad. It does all of that calculation. And the key thing is it loads in less than a second. It is loading in milliseconds. So that's how powerful and sophisticated the technology has to be able to serve a global network of advertisers that want to place relevant ads in front of people. Now, you've probably experienced this if you've watched one of those streaming services and the ads have come on and you've been watching it, and then all of a sudden the ad starts to roll and then the whole thing crashes or it freezes up or whatever. And that's probably where you've experienced where one of these advertising platforms have just stuffed the whole stream for you, and then you've had to get out and get back into it. It's one of the most frustrating things when you're trying to watch on the television. But that's basically what's happening in the background is, pardon me, is Trade Desk or other providers are trying to do the calculation. So it's not just any old ad, which then sits on your SBS on demand or on your Netflix. It's actually an ad that's relevant to you because it increases the likelihood that an advertiser is going to come back because they're getting in front of the right clients, not just any old person. So I'm going to quickly now jump back into the 10K, which you can access. So the 10K, so I've got in front of me here, I've got the website, the investor relations part on the website, but you can get all of this stuff also, pardon me, inside the Tiger Brokers platform. And don't forget, below the video, and I'll bring this up right here, below the video, you can see the giveaway is accessible here with the free account that you can open and go in the draw to win. However, I've just gone to the website here for easy access and because I like these little PDFs. So we can see the Trade Desk financials. This is just what we call the 10K, which is like their annual report, but it's a standardized report across all the businesses. And I've got that for all of them. So you can see how they're presented differently or much the same. This is the Google quarterly. This is the Google 10K. And then we've got the NVIDIA 10K, just a moment. So you can see here over time, the business's financials are kind of accelerating. So this is $1.3 billion for the 2023 financial year. As we'll find out in a moment, the Trade Desk is significantly smaller than Google, Amazon, and all the other businesses that we're going to talk about. This is why I want to spend a bit of time on it. Because if you can find the businesses early in their journey, if you can find them early in the journey before they start their growth, serious long-term growth phase, this is where you kind of get the sweet spot in terms of these types of things happening, right? Now, how big is the programmatic advertising market? So if we think about advertising generally, like digital ads is around about, I think it's over $1 trillion a year now. And that means that businesses around the world are spending more than $1 trillion on advertising their products and services. But within that market, there is a market that has grown even faster than the overall market, and that is programmatic advertising. And that is where Trade Desk sits. So if we go back to our waves analogy from before, and get rid of this horrible purple color, if we go back to our waves analogy, if we think about this being like the big wave that's moving through, which is digital ads like Google search and blah, 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 blah. Well, the other one in front of it would be programmatic advertising. And when the one in front gets hit by the one behind, which it already is, they form one big wave, and programmatic becomes bigger and bigger and bigger and bigger and bigger and more powerful. And that's effectively what happens here. Is this little surfer is like trade desk, and it's riding this massive wave, well, what it thinks is a massive wave, which is programmatic, and then the big kind of like wave behind it merges into it, and it really takes off. And that's effectively what we're seeing here. Over time, is companies like the trade desk are starting to accelerate because they offer programmatic advertising. So here on the screen, we can see how it makes its money. How it's spending its money. One of the things that it does is it reinvests a lot of its cash straight back into development of this platform because it is so sophisticated. And there are three major players here. Google's obviously the most well-known amongst the three, but Trade Desk is probably second in place, maybe third in place. So it's not the only one, so it has to continually innovate. But you can see the business, growing year over year. This is obviously 2023 on the left. You can see if we come right down, it tends to bobble between profitability and out of profitability, but over time, I'd say it's more profitable than not from one year to the next. If we come down to the cash flow statement, we can see at a cash flow level, very profitable. It does have a lot of stock-based compensation. It does pay a lot to its engineers and these types of folks. And that's just normal with a few of these tech stocks. Keep that in mind when you look at a business like this, that it's going to pay a lot out to its employees. Management team is aligned. It's riding a pretty slick growth wave. It's not guaranteed that it will win. Currently, the key thing, if you want to research this business more, the key thing for you to focus on is what's called UID 2.0. So UID 2.0 is Trade Desk's version of cookies in your browser. If you go to go to a website that says accept all cookies, Google is effectively trying to remove those, and it will be removing the cookies from your browser. A cookie, by the way, is just a little bit of code that sits in your web browser. Whenever you visit a website, it stores information about you. So it might store the website you came from. It might store information on the time that you spent on a website, and it might assign, say, something like was on a financial website. So then the next website can then serve you an ad through Google that is financial content, so it's more relevant to you. So because of a lot of the clampdown around the world, they've effectively removed that, and they're all trying to build a new system that doesn't identify a person individually, but can still serve them relevant ads. And Trade Desk has been one of the early pioneers on that, building something called UID 2.0. So UID 2.0. There are two others that are coming. Google's obviously building their own. And what's the other one? I can't remember off the top of my head. But there are a few that are trying to get built. If Trade Desk pulls that off, if the standard for that industry, remember how I said standards before? If the standard for the industry becomes Trade Desk and not Google, which is probably unlikely, but it could happen. Like Disney has already adopted it, like as in Disney streaming, Disney websites, this type of stuff. If the standard becomes Trade Desk's UID 2.0, even though Trade Desk doesn't own the standard, it's built it, effectively Trade Desk could grow for the next 10 or 15 years of this new way of advertising. So that's what you should be looking for as you begin to follow this company. So that's the Trade Desk. I'm going to give it a quick score. Growing sales opportunity, yes, 8 or a 9, I'd probably say. Defensive business model, I'm going to give it a 5. Remember that we're grading these companies in the context of the US. So don't compare an Aussie company score to a US company score, because the US company scores their businesses are much bigger. So more like compare this to this or this to this kind of thing. Is it a business model you can understand? It's pretty hard for most people to understand, but once you wrap your head around it, it's all right. Is it aligned management? Yes, management own a lot of shares. Strong profit and cash flow. Yes, I wouldn't. It's not as profitable as like Microsoft or Amazon these days, but I'd probably give it a 6. Is it at a reasonable price? Now, we won't have time to go into too much depth around that. You can jump into Ticker, or you can jump into, say, Tiger as well. I use Ticker for a lot of stuff. You go in, click on the valuation tab, and you can look at the valuation through time. So if we just go price to sales ratio, which just compares yearly sales of a business to its share price, and you can see that since it's fallen, it's actually, the multiple has collapsed. So remember before how I talked about where am I? How the multiple expands, it can also collapse, which is why it's, in my opinion, it's very risky to just invest for 1 to 2 years and just try and say, well, it looks cheap. What you really want to do is you don't just want to look at this, you want to also look at the sales momentum over time and how it can grow over the next 10 years. But you can see, compared to what it was really when it was really frothy in COVID, it actually is significantly cheaper. So it's only a price to sales ratio of 15 times, which is still pretty high for a lot of investors, but it was as high as 40, which would have been clearly overpaying for the business in the short term. So it's actually a pretty compelling valuation right now, I would say, for long-term growth. So I give it a 4 out of 5. G'day, Time Wars. Good to have you with us. Okay, let's be quick with these next three because you know them really well. I wanted to spend time on this because if you can take one thing away from today, it should be that Trade Desk is on your watch list, and it does deserve to be watched closely. It is much, much riskier than the other businesses that we've covered from the United States. These are all huge juggernauts, whereas Trade Desk, like Amazon, has a $1.7 trillion US market cap. What's Trade Desk these days? It'd be back down. Yeah, it's 34 billion. So this is what we would call a small to mid cap in the United States. For Australian investors, that's very big, but for US investors, it's actually quite small. So it's more of an asymmetric bet, meaning that it could collapse or over the next 10 years, or it could become the standard setter and the world beater. Now, Amazon recently released results, so let's jump into them. They are right here. Amazon's business is divided into a few separate segments. Most people know that the business overall, let's see where we got our, most people know that the business overall was based on an e-commerce platform, but has since expanded into offering cloud computing through AWS. The benefits of AWS, which are here, the benefits of AWS are that if you look at the revenue or the sales that the business makes, and you compare that to the profitability of the platform, so I should be looking here, you can see that even though these other businesses like Amazon.com, e-commerce, and so on and so forth, even though that makes up the majority of revenue, like the sales that go through the platform, the lion's share of profitability comes from AWS, which is cloud computing. And the reason is that if you're a software engineer and you know how to work with AWS, you can build your customer's technology platform on AWS, and you pay, and the customer, not you, the developer, the customer pays AWS a monthly fee based on their usage and so on. And basically, from AWS's perspective, all they've got to do is just build server farms around the world and make that they provision the servers so that the customer's website is available, so the customer's tech platform is available right around the world, 99.99% uptime. And all they've got to do is make sure that that's all running. As long as that's running, then they can collect really wide gross profit margins. So if you look at these profit margins, that's like a, 30% profit margin here. But if you look at the e-commerce business, which is where you get Amazon Prime and that, you can see the profit margin is tiny. Like, what's 14.8 billion divided by 350 billion? It's not a great profit margin, but it is improving because Amazon has got to the point now, and Kevin Fung, our senior analyst at Rask, he said to me this week that Amazon has got to a point where even the businesses that it's tried to hide for years, like the e-commerce business, are so profitable and at scale that they can no longer hide how profitable they are. And why would they want to hide how profitable they are? Because if they showed everyone how profitable they are, they'd get regulated. So they just make sure that they try and play them down as much as possible. And so we can see still the traditional businesses dominate. AWS is catching up, but so are things like third-party logistics. The thing to keep in mind for Amazon in the future is it's moving into things like healthcare, providing basically a subscription, kind of like your Prime Video subscription or Amazon Prime delivery subscription, but you access healthcare. Now, why would it do something like that? It's because healthcare is basically the only industry big enough that make a dent in Amazon's profitability, basically. So they move into those industries that really matter to people and to the world over time. So let's bring up Amazon's financials. Let's see if I can get this up here. Okay, so we've got Amazon's core data here inside the Target Brokers platform. You've got the description, you've got all these things down the bottom here. Filings, you've got directors. Andy Jassy, which he was originally from memory, the CEO of Amazon AWS, yeah, from 2016 to 2021. Super impressive. Basically stepped in for Jeff Bezos, who is the founder and now oversees a lot of it. You still got Bezos as chair. Now, if we go down to shareholders and we click on where are we? Individuals. Here we go. Insiders, individuals. And we can see Mr. Bezos at the top with his 988 million shares, which is more than Vanguard, BlackRock, and State Street, the three biggest index funds in the world. So he owns a bucket load of shares, and naturally, he is worth a bucket load of money because of his founding and shareholding in Amazon. Remember before how I said inside Tiger, you can look at the different segments. I don't know of any other platform that does this visually like this, where you can see all of that stuff we looked at in the financials before laid out in a beautiful pie chart here. So you can see how in the orange, right, you can see how AWS has basically come out of nowhere. AWS was originally built as a tool that only Amazon would use, and then everyone else asked them if they could use it, and they realized, oh, we can just put a subscription around the outside of the servers that we just built. We'll just do that and then sell it to other people. So then they started selling subscriptions for other people to store their information and technology on their platform. And then they're like, maybe we can make this into a thing that everyone buys. And then they started to do that, and that became AWS. And you can see how the sales component in that orange there has started to make up more. But if we had the same chart for operating income, so this is just for revenue, but if you had that same chart for the profit, so not the revenue, but the profit, you would see it's basically a reverse. That even though it accounts for this much in sales, it would account for the blue bar if it was profit. That's why AWS has been such a wonderful investment for Amazon. And that's also why it's moved into third-party logistics, which is also more profitable than traditional business. And these other things are actually really, really valuable to Amazon longer term. But as you can see, it's no longer able to hide how profitable it is. It's so profitable these days. It's now even starting to get positive returns on equity, positive profitability. And just for anyone that doesn't know this, but you might be wondering, well, how has it only, just recently become profitable? It's important to understand the difference between profitability and cash flow. From a cash flow perspective, Amazon has always been positive. It's just that it's been reinvesting so much that it could effectively get deductions off of its revenue and off of its tax. And so its profit looked negative, but its cash flow was positive. If you think about when you buy something off Amazon, so let's say you go and buy a Scrub Daddy sponge off Amazon, as I did recently. If you buy that sponge for say $5, you pay for that using a Visa and you pay instantly. That money goes straight to Amazon. But Amazon doesn't have to pay the company that supplies the Scrub Daddies for 30 or 60 days or 90 days in some instances. So effectively, Amazon collects the cash up front, and by the time it has to pay the supplier of the Scrub Daddy, it's already used that cash to reinvest in something else. And that's the wonderful part about Amazon. Okay, so if we jump back into, and I'll bring this up really quick, and I'll have to speed through the last two, but you guys know the last two pretty well anyway. So if we jump through the last two, I might actually score them all now and then explain these two businesses really quickly. So growing sales opportunity for Amazon, it actually is still growing very, very strongly. I don't think it's the type of thing that will move the dial for, like, it's still got a transition to online ordering and healthcare and that, but I think the fact that it has moved into healthcare has slowed it down a bit. Defensive business model, I'll give it a 9. Its logistics business is the best in the world. Business you can understand, 8. Most people can understand how it works. Maybe they struggle a bit with AWS. Aligned management, 9. It's at a 5. Sorry, I should be doing a 4.5, and same with this, 3.5. For strong profit and cash flow, 9. It's not fully profitable. It's fully cash flow positive, not fully profitable, which is a good thing because you pay tax on profits. You don't pay tax on cash flow. It's a different thing. So reasonable price. We could go back into it before, but it's pretty reasonably valued. I'll just stick with that for now. It's slowly maturing as a business, so you don't want to pay super high profit margins for it, but it's got a big opportunity still in front of it. Now, NVIDIA, growing sales opportunity, probably the most impressive sales opportunity. Bit buzzwordy at the moment, but unbelievable growth from NVIDIA selling AI-related tools, hardware, software, etc. So NVIDIA creates the graphics processing units and all of the infrastructure and design capabilities that go into creating tools of the future. So things like CPUs, GPUs, or graphics cards, all of these things that go into cloud computing, like Amazon is using, like Google is using for GCP, which is Google Cloud Platform. Um, it creates the software, it creates the GPUs and the CPUs that power those server farms. It also creates things that like go in your personal computer for graphics cards and gaming and augmented reality. Apple's new VR headset most likely probably has some inspiration or some tooling from NVIDIA, and so on and so forth. So every tool that uses AI or virtual reality or the Meta platform will have some part of its ecosystem basically running through NVIDIA, or at least inspired by NVIDIA if they go through another provider. So defensive business model, it's actually really defensive nowadays. It wasn't maybe 5 years ago. Business you can understand. Most people can understand. It's probably not as understandable as Amazon, probably more understandable than Trade Desk. Aligned management, absolutely, with Jensen at the top. You have super aligned management, even and a visionary management for that matter as well. Strong profit and cash flow, absolutely. Its inflection point, I'll show you in a section, has been unbelievable. Reasonable price, I'll give it a 1. Even though, I'll give it a 2 maybe. Even though it's growing super fast, people need to be realistic. Even though, the reason why I'll give it a 2 out of 5, which is not necessarily a good score, is I think NVIDIA can grow through its current valuation. Like it can keep growing through that, and then the valuation will look good. But a lot of investors can't hack this part. If this chart was to happen, it would be NVIDIA that gets sold off first because it's so highly priced. But if you could hold through that, I think it'll be okay longer term. Growing sales and opportunity for Google, which is the owner of Waymo, which is self-driving technology, Google Search, Google Bard, which is the AI that it uses and builds, Google Cloud Platform, YouTube, etc. We'll have a look at the financials in a second. I'll give it, it's probably a little bit better than Amazon, but not as good as NVIDIA. Maybe I'll give NVIDIA a 9. Defensive business model, yes, but not as defensive as people think. Google is still highly, highly dependent on Google search advertising, which is changing rapidly with the arrival of OpenAI, which enables you to have basically a voice assistant and a conversational assistant. So a lot of people nowadays, I'm finding, are using OpenAI's ChatGPT or even Google Bard's, like we use Google Bard, I'll show you at Rask. We use Google Bard instead of Google Search a lot of the time. Now it's renamed as Gemini with the new release. But say, for example, I say, what are the 10 best restaurants in Melbourne? And then this is the key thing. If I have gluten intolerance, right? I don't, but let's say I did. Normally, if you put this into Google search, you'd have to put it in and you'd have to search through all the blog posts and all that sort of stuff. Well, now you can put this in and it will come up with all of the things contextually aware of what you've said, which is I have a gluten intolerance, right? That's an interesting one. So all of these things come in, right? And so why would I use Google search if I have a better thing here? You'd probably only use Google search for really quick, snappy results. But in the future, you would just ask Gemini or ask Google, or ask ChatGPT. So for the first time, we've seen this a genuine competitor to Google's products. So that's why I say it's still a wonderful business with lots of growth ahead of it. But how this changes in the future, I'm not 100% sure. So I wouldn't be doing a lot of baking a lot in that. Google business you can understand, probably an 8. Aligned management, yeah, still got the founders involved, albeit in a different capacity these days. If you've ever wondered why Google stock trades under these different ticker symbols, so there's 2 different ticker symbols for Google. The reason is that this one is for common folk, I'll say, for common investors like you and I, and you can buy these ones, but these are basically voting preference. I think there's another share too, but these ones are effectively the ones that have a higher vote attached to them, basically. And that's really it. Strong profit and cash flow, absolutely. So put that there. Is it a reasonable price? Let's have a quick look. Let's go Google like this. And we should be able to use, we don't have to probably use price to sales. We could probably use something else. Lyle, yeah, Chooks did just lay an egg. I'm at home today. I work at home after a big couple of years, Lyle. I now spend a lot of my time working from home. I actually find that I get a lot more of my deep work done at home. I'll explain why in just a minute. And so we can see the valuation of the business. Let's get rid of that section. Valuation of the business. This is basically what I would call the Chat GPT fear post-COVID. People realizing how good Chat GPT was and being like, oh my God, we're not going to be able to, how's Google going to survive with everything's going to change? And yeah, it might in time, but not straight away. You can look at Google's financials if you go here. We'll go to the most recent financials actually, and you can see the business is still monstering its results. It's growing at 9 or 10%. Telstra doesn't even grow that fast, and Telstra is just a tiny business compared to this. It's still growing at 9%. Even though it's a $1 trillion business, its profit is still growing at huge rates, even though it's a monster of a business. I remember a few years ago, like after COVID, like maybe even a year ago, people were so scared about owning these tech stocks because they were laying people off and all sorts. You got to remember, they don't need an infinite number of employees to operate its business. And I think they have that here. They reduced their headcount by 8,000 year over year. And so there are also some risks, guys, to Google's business particularly through this network business. Through its network business. So people probably don't really know what this means, but Google places ads on blogs and other websites. And to do that, it has to pay a little bit of a share to the publisher of that website, right? Like say New York Times or the Rask website or whatever. And basically, unless they can continue to provide that, they may not earn that income from that channel. Fortunately, they control enough of their own platforms these days that they can advertise on. They don't really need to use them as much. But in the early days, they relied on bloggers. They relied on all those other platforms to grow their business. And if we look in NVIDIA's financials, because I just said I would show you this. Where am I? Owen, where are you? Get to the financials. You know what? I'll go jump back into the Tiger platform. We'll go here, and then we'll go NVDA, go like this, NVDA. If I can get, there we go, Owen, you got it. Congratulations, we're here. Okay, so here we can see the business's revenue year over year. So here in this chart, you can see, and why don't I bring up the chart, and I'll bring up here total revenue. If you can see this chart in the green, you can see how fast its revenue has accelerated over the last few years. And if we go to operating income, we can see it's maintained profitability in that time. The income statement will show you the absolute numbers. So here down the bottom, we can see it's gone from the 2020 financial year of $11 billion of revenue to the most recent year of $27 billion, right? That's insanely fast growth from $7 billion to 17 to 15. Insanely fast growth for a company that is already at scale. If we go into the same shareholder information and we go down to the individuals, we can see Jensen Huang here. He has 3.5% shareholding in the business, so very much aligned indeed. And the profit margins on this business are actually wonderful too. You can probably see short interest over time, people betting against it. Oftentimes what you find with businesses that have a lot of short interest, so the businesses that people are betting against, typically what happens is the companies that are most bet against are the companies that are trying to redefine the world. So what I mean by that is, if you remember Afterpay, it was really polarizing. You either loved Afterpay and you thought it was a wonderful invention, or you thought it was an absolute catastrophe and you think it's the worst thing in the world for consumers and stuff. And in the middle was a business that was breaking the rules. What I've learned in coaching businesses and working with businesses, investing in businesses, running my own business, is that the businesses that achieve ultimate success are the ones that cause the most friction on the way through. They're the businesses that everyone has an opinion on, and only someone's going to be right. Because if everyone agreed with you that NVIDIA was the greatest growth stock in the world, if everyone agreed with you, then you wouldn't have a good chance to buy it at a reasonable price. And David Gardner talks about this a lot. He says he searches for people. He searches for companies. One of his key criteria is searching for companies that other people have said are overvalued. He goes into the news and he tries to find the companies that people say are the most overvalued. They're the ones that he looks to buy because it shows you that other people think they're not worth investing in, and that gives you the opportunity. Now, of course, you can't just do that. You can't just go in and be like, well, some geezer on the internet said that this looks overvalued, so therefore I'm going to buy it. You have to then have a whole other criteria, which are all of these other things that we talked about. Like, it has to actually be a good business. It has to have a defensive business model. It has to be able to grow fast. It must be one that you can understand. It has to have a aligned and talented management. You can't just have those management teams that are out there saying, we are the world's best at XYZ. Trust us because we have this wonderful business model. It has to have strong profits and cash flows, has to have runs on the board. Normally, the types of companies that go on to do all of these things we've talked about tonight are not companies that were penny stocks. If you want to invest this way, you don't have to do that. One of the great things about the United States stock market is a tech stock that's $30 billion is still considered small. Or in Australia, a company that's $2 billion is small if it can achieve national and global success. So you don't have to be filtering through all these speculative pieces of crap. You can literally just go to the businesses that already have the growth, that already have profitability, that already have a product that people use. You don't have to go all the way down the bottom into the dark corridor and open the door and try and find this little stock that no one's ever heard of, that has someone that's sitting at the desk telling you how amazing they are and doesn't actually have a product that they've already sold. You can find these gigantic businesses that are already growing, that have a product that you know, that have wonderful management teams, that are defensive businesses, that are growing into the future, that have multiple ways of winning, that have really strong cash flow, really strong balance sheets. You can do all of that. And that's basically what we've covered on the Tiger Stock series over the last few months. There's been some ugly ducklings. So if we go back through particularly the early sessions, like with Flight Center and Qantas, especially Qantas, yikes, I wouldn't own that thing other than through an ETF, which unfortunately my ETF has Qantas. If I could own the ETF, just get rid of Qantas, please, I would do that. Even BHP, there are certain instances where I love it and hate it, but I probably would buy it. But it's not my first choice. Obviously, I'd rather own tech stocks and software companies that are changing the world and blah, 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 blah. We've covered businesses. So let's just have a quick look back through this list. So the highest scoring Aussie company, let's just get them and put them all side by side. How about that? If we do that. So the highest scoring Aussie company was WiseTech. WiseTech I interviewed the founder of this company recently, Richard. That was the first ever long form interview he's done. So it's up 1,800% already. It's a $25 billion company. It's a global company, even though it's Australian business. I actually think in 10 years from now, WiseTech, I was saying to some friends the other day, this is not a stock recommendation, by the way, but I was actually thinking to myself, I reckon WiseTech could be one of the biggest companies in Australia in the next 10 to 20 years. I think it could be bigger than the banks. Now, that's assuming that everything goes right. So don't hold me to that. I just actually think that it is a wonderful business run by a wonderful team that offers the world-leading product in third-party logistics software. I could be very wrong, and I don't own shares right now. So keep that in mind. I also said it was overvalued at $20, and that was on national TV with Koshi. So don't trust. That's not a guarantee or a forecast. It's just me being honest with you. And so I'm not surprised that we gave it the score that we did. Qantas is obviously a dog and might be right for someone that's looking through the trash and wants a cheap stock. I definitely don't. ARB is a wonderful company, but it's probably too expensive. Gavir, you've asked, why is NAB here and not CBA? I just chose 8 random companies, Gavir. So I've spoken a lot about CBA before in other live shows that I've done, but not for Tiger stocks. So I haven't done NAB a lot, so I figured for Tiger stocks we'd do it. I know a lot of the Rask community owns NAB in their brokerage account, so I figured I'd cover it. Altium was, so we got the podium finishes WiseTech, Altium, and then ARB, which is the Bull Bar and 4x4 accessories company. Then if we switch gears to the United States, The winner is Microsoft, which is probably not a surprise to I'll give you your employee of CBA. I think CBA is the highest quality bank in Australia, give you, just so you know. Like it would get in my book, it would get a higher score than CBA. The only one that could maybe challenge it is Macquarie Group, which is not really a traditional retail bank. It's an investment bank, but it's always been for me. It's always been in this order: CBA and Macquarie, the two highest quality, and then NAB for business banking. But CBA, as you no doubt will know, is pushing into business banking pretty aggressively. So it's trying to challenge NAB there. But NAB's, just look at NAB share price, hasn't really done that much compared to CBA, which is a tech first kind of bank. So in the United States, the highest scoring is Microsoft, is the podium number one place. And then right behind that, we have Amazon as number two. See, Microsoft is a much, much, much more profitable company than Amazon. But Amazon probably is it's a very different business. Maybe I wasn't very kind to Amazon when it comes to the growing sales opportunity, because it does still grow very aggressively. It can still snatch some of that digital market share from groceries, Amazon Prime, that sort of stuff. And it does now sell more advertising in Amazon itself. Businesses can put their ads for their products in Amazon, as well as on Prime Video and all that sort of stuff. And then what else have we got? So it went Microsoft, Amazon, and then Apple in third, which probably makes sense given they're the three of the biggest companies in the world. Of these businesses, however, well, what's interesting is Costco, which is right behind it. Costco is a much, much smaller business than a lot of these others on the list here. So if we go cost stock, Costco is only a $300 billion company. So it's a lot smaller, but it's still super high quality. Its margins are thin, as we talked about in that session. Trade Desk is obviously Google's. Didn't finish off this last bit here, so it's a bit cheaper. So Trade Desk is the lowest. If you're thinking about companies with the longest growth prospects, it's probably, I dare say it, even though it's a bit of a meme at the moment, you'd probably have to say NVIDIA. Microsoft has some great growth prospects as well, though. Probably have to say NVIDIA. Like Tesla does have a big growth opportunity, but I don't own shares. I've never owned shares of Tesla other than through the FANG ETF. But you'd have to be really mindful if you do own Tesla shares. You have to be really mindful of the catch-up effect that's in play, especially from businesses like BYD and other Chinese-made automotive businesses. Tesla still has the clear advantage on autonomous driving, like a car that drives itself. But in terms of like electricity running through a car, the others are not far off catching up. Now, Tesla's still the best. It still has the best chargers. It still has the best network. It's still all of those things. But it would be a mistake if you were a Tesla shareholder comparing Tesla to Ford, comparing Tesla to Chevrolet, comparing Tesla to Chrysler. Like those car companies are basically dead in the water, as well as some of those European companies. Like even, dare I say it, companies like Mercedes and BMW and Porsche, those businesses are not able to compete with Tesla in terms of electric vehicles. However, Volvo, to an extent, Mercedes are catching up, but Tesla's definitely the winner there. But don't compare Tesla to those businesses. Compare Tesla to the Chinese automakers. That's what you should be comparing to, because they have the infrastructure, they have the EV, they have the engineering capability. Even if you look here in Australia, all of the Australian Teslas are made in China. So yeah, keep that in mind if you own those companies. So at the end of the day, we've come across 16 absolutely wonderful stocks over the course of the Tiger Stock series. You can create yourself an account on the Tiger Brokers website. If you follow the link that's right here below, it goes to this page, and you can figure out all the T's and C's from there. If I'm not mistaken, Tiger recently became a chess-sponsored investing platform, which is a big deal because what that means is effectively your shares are held in your name with your own unique identifier, which is basically identified at the ASX level, which is a big thing for people in terms of trust and that type of thing. So keep that in mind. You can then go in and you can click that link. It's free to sign up for an account. The app, I would say for most people that are long-term investors, the app, which I can't show you on my iOS, is actually a better experience than the desktop version. But yeah, it's a wonderful platform to help you discover investing. Okay, so some quick questions. Lyle said, "What do you think of Toyota?" Lyle, I think Toyota is a wonderful business. I think Toyota has a lot of ambition when it comes to EVs. I think they've maybe taken too long. I think the others have caught up too quickly. But of all the providers, I would say Gavir said the same thing. Kia, Toyota, and Volvo, in my mind, from what I've seen, are the three businesses of the legacy cohort that have done the best in trying to keep up with Tesla. Those three businesses in particular have done the best, like having driven in all of those cars that are EVs. I own a Tesla myself, and I still think that Tesla is by far and away significantly better than all the others. However, having been in them all, I would say the Volvo is the one that is the closest for performance and that type of thing. If you're going for cost, and I think this is where Tesla may lose, you wouldn't look at Kia and you wouldn't look at them because you don't get the performance. You would go with BYD because BYD has, let's say it's like 80% or 70% of the performance and the features of a Tesla, not including autonomous driving. Don't think about that, but just think of like the actual car itself. BYD is probably like 70%, 80% of the way there, but you're paying $20,000 or $30,000 less, depending on where you are in the world. Whereas with a Volvo, you pay more than you do with a Tesla, and it's probably still slightly inferior technology, although it goes close to matching it in terms of capabilities and that sort of stuff. Again, excluding autonomous driving. Tesla's still the winner there if you want autonomous driving. Like I don't know if any of you have seen or felt this, but it is a freaky feeling when you're in a Tesla and it drives itself and the steering wheel is moving. It is weird. And I do it quite a bit, especially on highways and on suburban roads, but it's freaky. But you can see that there's no other automotive that's come close to it. There will be, like the Waymo car from Google uses that technology, and Google's doing a different play. Google, unlike the Pixel, which Gavir mentioned before, Google is, instead of making the cars, it's made the technology which the other cars will use. It uses a different technology. So Google's Waymo cars it's kind of like a radar technology. It kind of builds a map around the car, whereas Tesla's uses a combination of GPS and cameras. And so slightly different technology. Tesla's obviously the winner because it's mapped the most. But Waymo's self-driving. Waymo is fully self-driving, in fact. Like you get into a taxi in Phoenix or in some of the US cities, it drives, you get into the Uber. It's not called Uber, it's Waymo. You get into the Waymo and it drives you from destination to destination safely too, which is a good thing. So yeah, that's it for the Tiger Stock series, guys. Go and create yourself an account. If you use that link, you can go into the draw. Rask doesn't make anything from you going into the draw and doing all that. We did get paid a fixed fee set in advance for doing these live shows, which has been heaps of fun. And the link is there. If you are the lucky winner, the team at Tiger credits the account. It's all in the terms and conditions there that you can check out. I just want to say thank you to Tiger for putting this on for us. I haven't done many live. This is the first live I've done this year, and we don't do as many of these this year because I'm focused on other projects at Rask, including many of our own things, which you know are coming up. If you're on the mailing list, please let me know. We will be doing more lives over the next few weeks. All of the partners and podcasts at Rask will be doing live shows. So each of the individual channels, so the hosts on the Australian Property Podcast, the Australian Business Podcast, everyone will be doing live shows but it won't always be me. That means that Rask will still go live 4 or 5 days a week with different experts across Australia and across the world. It just won't be me every time that's doing it because I'm be focusing on a lot more investing this year. Um, Lyle, thank you for your time. I really appreciate all of you. And Gavir, thank you for the challenge, Jayesh. Everyone that tuned in today, this is available on playback anytime, as well as the other Tiger stocks. So please go and check them out. The link's the same. It's still there. Go and check it. It's in a separate Tiger Stocks feed under the live part of YouTube. There'll be plenty more to come. I'll see you soon. You can get in contact with me any way you like, Twitter or X, whatever it's called. Who knows if it will change back. You can send me an email as well. Bye for now, guys. Have a wonderful rest of your day. And 2024 is shaping up to be a great year for investors. I think we need to look outside the usual suspects in 2024, like the massive, massive growth of these big tech stocks. I think you want to be looking at that second tier going forward. Things like the trade desk, not to say it's a buy, but you want to look at these types of businesses, the Costcos of the world, these types of businesses as much as the existing players and incumbents. All right, guys. Thanks, Jayesh. Thanks, guys. I'll see you next time. Wonderful to have you here today. And thank you again to Tiger Brokers.